that, let's bring in our guest, Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Tom, thanks for joining.
Thanks for having me, Anne.
Tom, let's just talk a little bit as we start this new week. We have got the Fed coming out soon with the latest on its rate decisions. When is that happening? What are you expecting?
Well, that's next week, May 3rd, and the Fed has reiterated that they're data dependent. They're going to get an awful lot of data, which you touched on. First and foremost, you have 15% of the aggregate market cap of the S&P reporting in the next few days. Just Amazon, Google, Microsoft, Amazon, Alphabet, Microsoft, and Meta alone are $5.1 trillion of market cap. And I think that's going to say a lot about when you look at advertising on Alphabet and Meta. That's going to say something about the consumer spending. When you look at Microsoft, it's going to give us some color as to enterprise spending. And then the big story with Amazon is going to be the cloud spending, and AWS. Has the deceleration slowed? And are they going to give us a little bit of guidance that things could look a little bit brighter going into the end of the year? You know, it's very unusual and for Amazon to have two bad reports in a row, which they've had as it relates predominantly to the over warehousing and over hiring during the COVID demand period and now unwinding that. So betting on a third bad report, I think, would be a lot to ask. And I think that may set things up for a positive surprise for Amazon, potentially, certainly positive guidance. They won't be seller, but you know, the secret to happiness, as they say, is low expectations. And we've certainly come into the earnings season with low expectations, as you referenced.
Let's talk about that, Tom, because I joke, but not really, because it's never good news when a company goes bankrupt, at least in the immediate term. You know, your heart goes out to the employees and the distress that it causes when you hear employer is going out of business. But let's talk a little bit about Bed Bath & Beyond. You would have thought that there would have been low expectations there, right? That company has been on the precipice of going under for years. It has clearly failed to do well in the challenge of online retail. And yet, you know, some of the coverage is saying that Bed Bath & Beyond, this bankruptcy, is a swift decline. It didn't feel like a swift decline. I mean, has the street been surprised by this?
Right. This is the slowest motion train wreck you've ever seen. You know, it's tying it into Amazon, by the way, is Jeff Bezos' famous quote, "Your margin is my opportunity." And I think we saw evidence of that this week with Bed Bath & Beyond. Yep. But they did make a strategic error, Anne, in that, you know, they've seen it. It was declining in 2019 before COVID. Certainly COVID pushed it over the edge. You saw the decline in the numbers. But they did have $1 billion of cash, and they spent that on buybacks over the last couple of years versus inventory. So people effectively stopped going to the stores because there was nothing to see.
Yeah, that's a great point, Tom. And let's talk a little bit too. Retail investors lost $140 million on Bed Bath & Beyond this year, according to Bloomberg analysis of Vanda Research data. The 99% drop in share price in 2023, though, got short sellers' profits by about $142 million. What lessons can be learned here for retail investors?
That's a great question. You know, the number one thing, Anne, is to know what you own. You have to do balance sheet, income statement, cash flow statement analysis before you own a business.
Fundamentals.
Yeah, it's one thing to say, oh, I like their store and I like that they mail me coupons and, you know, Bed Bath & Beyond will never go, or I like the movie theater. We all like certain things, but at the end of the day, some decent assets can be mismanaged, and this was certainly the case with Bed Bath & Beyond. It's unfortunate. It's sad to see with the employees, but I think the takeaway is don't just buy it because you like the brand or you like the name. Take some time, look at the balance sheet, look at the debt levels, look at the cash flow, look at the cash on the balance sheet, listen to a couple conference calls, get a sense of management, the investor presentations, the outlook. And I think if you do that, you'll save yourself from situations like this and really doing independent work and independent thinking.
Tom, on that note, let's talk a little bit about some other names as we continue to ride this earnings wave. You've talked about tech. What are some other sectors that you've looked at where you've done that fundamental analysis and you said, you know what, perhaps these sectors have been overlooked. Tech has been going on the up and up over the last 90 days, but some of these other sectors are places I should start really thinking about now?
Yeah, I think that's a great question, Ann. First and foremost, tomorrow you've got 3M. Okay, 3M is a fantastic compounder. For over a decade, they've been compounding capital, return on invested capital, mid-teens to low 20s. That's stellar. Why is the stock down so much? Because of litigation overhang. They have the earplug lawsuit and they have the Forever Chemicals lawsuit, and I'm hoping that we'll get some color on that. But, even when you look at the worst case scenario, which analysts are looking at, maybe it's 20 billion, maybe it's 30 billion, that wouldn't be paid out all at once. It would be paid out over a decade, number one, if the worst case scenario came to pass, and our bet is that it doesn't. And their dividend, if you look at the cash flow statement, they spend over $3 billion a year on a dividend. So even if the worst case scenario came to pass, and they cut the dividend, that does not impair the business's ability to compound capital over time. So I'm very eager to hear what 3M has to say about their underlying business. Maybe any color on these lawsuits, a potential resolution or progress would be very, very good at these levels. And then Intel, which everyone hates. It's the, redheaded stepchild of the semiconductor industry. But I do think we're at inventory peaks for servers and for computers, if not this quarter, maybe in the next quarter or two. And you've seen in some of the other semiconductors. So I think people are skeptical about Gelsinger's turnaround plan with doing high-end chips and competing with NVIDIA. But you don't have to believe that part of the plan to be kind of interested in what's happening next with Intel. Because if we're right about inventory peaks, just their boring business of PCs, which they control, and server chips could be a monster if we are indeed at peak inventory levels. So I'm eager to see the guidance there.
Tom, you've always kept your finger on the pulse of the macro, and we've talked about lots of different macro indicators in the past. We've just talked about the Fed. Where's inflation at right now?
Yeah, speaking to your earlier question about what I'm also paying attention to, besides the earnings data the Fed's going to get, obviously, is core PCE on Friday is going to be critically important before that May 3rd. Estimates are 4.5%, down from 4.6%. As well as initial jobless claims are expected to be 248,000. So if we get a core PCE below 4.5, if we get initial jobless claims above 248, maybe we get a final dovish hike. You got 91% in the Fed futures odds of another hike here. So it'd be the data would have to be really different than expectations for them to do nothing next week. So odds are they do something. The question is it going to be dovish, like, hey, here's our hike. We got up to the terminal rate of 5.1. Have a nice day. We're going to keep rates elevated. Or is it we got to our terminal rate. Now let's see what happens in the next month, and maybe we have to go again. And if they do that, that could be really bad for the market. But I think more likely it's one more and maybe some softish speak out of that. We've reached the terminal rate. We're keeping an eye on inflation. But the data points this week are going to play a critical role in that.
We've still got you for 2 minutes, Tom, so I'd love to get your opinion on the following since we're talking about inflation. Coca-Cola talking about 11% price increases.
Yeah, no, there's no question. And if you look at Coca-Cola, though, Coca-Cola has been able to do that pretty much every year for the last 40 years. So it's not related to COVID. It's not related to our supply chain issues. It's related to the unbelievable moat that the Coca-Cola company has built around its magic formula and marketing over the last 40 years. The other thing, 11%
PE. This is a big one.
This is
a big hike.
This is not nothing. Yeah, I will agree with you. It's bigger than usual. But I also, and I know we've talked about in the past, I'm really focused on this owner's equivalent rent because it's such a critically large part of the CPI, and we started to see the big step down function in the most recent report, and I think we're going to see it now on the 12-month lag from last year, and we've been talking about this for months. May, June, and July, it's going to be material. So not in time for May 3rd, but certainly in time for the June meeting. And with the weight in CPI and the 12-month lag on those leases, which are coming down, you've seen all the same stuff that I'm seeing from Redfin and from Zillow and et cetera. That's going to be a really good news for CPI as we come into the summer months on the base effects from last year. So we remain optimistic on that front, but we'll see as the data rolls in.
Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Thank you, as always, for joining us here at Public Live. And that is it, folks. You can hear the closing bell ringing. Come back, same place, same time, rest of this week. And also, don't forget, 9:15 a.m. Eastern Time, joining for the Open. Have a good one.
Thank you.